Hello everyone, and welcome to this explainer. If you're a focused learner who loves breaking down complex business realities into clear, structured insights, well, you're in exactly the right place. Today we're diving into a genuinely fascinating contradiction. We're calling it the $5 trillion paradox. See, on one hand, we have Nvidia's massive, completely unprecedented valuation, driven by all these headlines about total market dominance. But on the other hand, hidden just beneath the surface are structural market realities that tell a much more nuanced story. All right, Section 1, the paradox, unpacking the $5 trillion giant.
Okay, let's dive into this. To really unpack a giant of this size, we've got to look past the daily news cycle and use a classic diagnostic tool, Porter's 5 Forces Strategy Framework. Because when you strip away the hype, $5 trillion is literally a staggering number. Nvidia smashed past this market cap milestone following a massive Q1 fiscal year 2027 revenue report of roughly $79 billion. That totally beat Wall Street's consensus and confirmed an unbelievable 75% year-on-year growth rate. So naturally, the prevailing narrative out there is that Nvidia essentially owns this multi-layered cake of AI infrastructure, rendering them virtually untouchable. But as you'll see, when we look at the actual market share, a surprising trend starts to emerge. While Nvidia remains an absolute giant, capturing the vast majority of the pie, their data center GPU market share as of mid-2025 has actually slipped slightly. They're currently sitting at roughly 88 to 92%, which is actually down from approximately 95% just a year earlier. So before we apply the 5 forces framework, we need to set the table with some hard data. These 4 critical numbers right here form our foundation. First, we have that 88 to 92% market share we just mentioned. Second, a massive $635 to $670 billion in 2026 combined CapEx commitments from hyperscalers like Amazon, Google, Meta, and Microsoft. Third, we have 100% foundry concentration, meaning TSMC produces the entire Blackwell and Hopper line. And finally, we're seeing easing U.S. export controls, highlighted by the recent clearance of H200 exports to roughly 10 Chinese firms. These 4 metrics, they are exactly what our framework needs to explain. Moving on to Section 2, the shield, forces defending the moat. Let's look at the first defending force, the threat of new entrants. This is incredibly low, but surprisingly, the true barrier isn't the physical silicon itself. It's the massive software switching costs. Think about it for a second. OpenAI is reportedly exploring its own chip, right? But even if they manage to ship a viable piece of hardware in 2027, the real question is whether their own teams can afford to refactor a whole decade of code that is tightly coupled with Nvidia's CUDA architecture. Every research lab, every PyTorch optimization, it's all written against Nvidia's instruction set. The wall that new entrants face is mostly software, not mostly fab. The second force acting as a shield is buyer power, which is structurally moderate, but currently, it's very weak. Now, you might be wondering, how is that possible? Hyperscalers control the buyer side, and they have over $635 billion in orders. In any normal market, 4 customers with that kind of budget would have crushing leverage. But they don't have it here. Why? Because hyperscaler demand drastically outstrips Nvidia's constrained TSMC supply allocation. And, well, when supply is the binding constraint, the seller gets to set the price. Up next is Section 3, the cracks, pressures breaking the moat. Now, what's really interesting about this next point is that it's a pressure that stock prices, and honestly a lot of analysts, just haven't fully priced in yet. Nvidia's bottleneck isn't its own engineering. It's an extreme reliance on high supplier power. TSMC sets the prices for the 3nm and 5nm processes required for those new Blackwell chips. SK Hynix and Samsung set the prices for high-bandwidth memory, or HBM3E. And upstream of all of that, ASML sets the lithography prices. Nvidia is a massive customer, absolutely, but at the end of the day, they are still just a customer. Margin compression from these suppliers is a very real threat for 2026 or 2027. Another major crack in the moat is the threat of substitutes, and guys, this one is rising fast. Generative AI is shifting from the training phase, where Nvidia is completely unmatched, to the inference phase, where it is all about price per query. For inference workloads, custom ASICs and specialized chips like AWS Trainium, Google TPU, and Microsoft Maya are actually undercutting Nvidia on tokens per dollar. Generic GPU silicon was simply never the right shape for inference economics, meaning substitutes are gaining some serious ground. Which leads us to what is probably the most misunderstood competitive threat in this entire space. It's a classical strategy concept called vertical encroachment.
Basically, this happens when your largest buyer is simultaneously funding and building products to become your largest competitor. It completely breaks the traditional rules of how we view market rivalry.
So the real rivalry is coming from inside the house. Every hyperscaler buying a piece of that massive $635 billion pie is essentially wearing two hats. And honestly, neither is a particularly friendly one. On one side, they're Nvidia's largest customers, heavily funding the ecosystem. But on the flip side, they are using those exact buyer-side budgets to develop rival custom inference silicon, making them Nvidia's fiercest competitors. Okay, Section 4, the secret weapon, the sixth force.
Now, Porter's original framework only had 5 forces, but former Intel CEO Andrew Grove proposed a sixth force, complementers. And this right here is Nvidia's ultimate trump card. As the saying goes, the moat isn't transistor density, it's the 50,000 PhDs whose code runs on green silicon by default. Every single framework and fine-tuning pipeline assumes Nvidia hardware. The true lock-in holding this entire multi-trillion-dollar ecosystem together is that massive army of researchers. But here is what you really need to take away from this. The complementer moat is a one-way ratchet. As long as Nvidia ships new generations on a tight 2-year cadence, that ratchet holds tight. But the day there is a 12-month gap where a competitor is meaningfully ahead on price per query, that ratchet starts to slip. Researchers are pragmatic folks. They will rewrite their code once for a cheaper, faster platform, and then they'll happily keep writing on that new alternative.
Section 5, the future test. Looking past the 2026 victory lap. Right now, Nvidia is essentially taking a 2026 victory lap with Blackwell. Hyperscalers are raising capex and margins are expanding into the supply crunch. But if we want to see if the market forces have actually shifted, 2027 provides 3 exact signals to watch. Step 1. Keep an eye on TSMC's 2-nanometer allocation. If a hyperscaler or AMD gets first-wave access on equal terms with Nvidia, supplier power has officially shifted. Step 2. Watch the inference revenue. When customers start reporting that more than 40% of their AI cycles are running on internal silicon instead of Nvidia GPUs, the substitute force has hardened. And Step 3. Watch the tool chains. When major frameworks like PyTorch ship first-class support for non-Nvidia paths with parity benchmarks, you'll know that the complementer ratchet has finally slipped. Finally, Section 6, the playbook, strategies for 2025 and beyond.
Because understanding the landscape is only half the battle, right? Here is the actionable playbook derived from all this analysis. If you're a SaaS founder or running an AI model-dependent business, you should assume your unit economics will actually improve over the next 36 months as substitutes compress Nvidia's pricing power. Whatever you do, do not lock yourself into 3-year compute contracts at high 2026 prices. If you're a competitor building in this space, you've got about an 18-month window. Don't try to win the whole shebang. Own a specific niche, like long context inference, before the broader market consolidates. And if you're evaluating the stock, remember that the moat is definitely real, but you need to look for the asymmetries in these underlying forces, rather than just cheering a single quarterly earnings beat.
So, we've explored the massive scale, the software shield, the hidden supplier cracks, and the ecosystem ratchet holding it all together. Remember, strategic frameworks aren't predictive, they're diagnostic. They help us cut through all the daily noise. So as you watch this incredible industry unfold over the coming quarters, I want to leave you with this one critical question to ask yourself. Which of the 5 forces will move first? Thank you so much for learning with me today and keep asking the big questions.